Topic introduces money market and capital market instruments, which are fundamental components of financial markets and institutional liquidity management. Money market instruments are short-term debt securities with maturities generally less than 1 year, designed primarily for liquidity preservation and short-term financing. Common examples include treasury bills, commercial paper, certificates of deposit, repurchase agreements, and bankers' acceptances. These instruments typically offer high liquidity and low default risk, making them attractive for cash management and short-term investment needs. Capital market instruments, in contrast, involve longer-term financing and investment activities, including bonds, equities, preferred shares, and long-term loans. Together, these markets facilitate capital allocation, economic growth, and financial system stability. The topic explains that money market instruments are critical for maintaining institutional liquidity and supporting day-to-day funding operations. Financial institutions, corporations, and governments use these markets to manage short-term cash surpluses and funding shortages efficiently. Because maturities are short, interest rate sensitivity and price volatility are generally lower than in long-term securities. However, money market instruments are still exposed to liquidity risk, credit risk, and refinancing risk during stressed market conditions. The topic highlights how disruptions in money markets can quickly affect broader financial stability, as demonstrated during financial crises when interbank lending and commercial paper markets experienced severe liquidity shortages and declining investor confidence. Capital market instruments serve different purposes by supporting long-term investment, economic expansion, and portfolio diversification. Bonds provide fixed income returns with varying degrees of credit and interest rate risk depending on issuer quality and maturity. Equity securities represent ownership claims and offer potential capital appreciation, although they expose investors to market volatility and business risk. The topic discusses how investors select among capital market instruments based on risk tolerance, return objectives, liquidity preferences, and investment horizons. Capital markets also enable governments and corporations to raise substantial long-term financing for infrastructure, expansion, and strategic initiatives. Efficient capital markets therefore contribute significantly to economic development and resource allocation. Topic also focuses on investment security selection and the risks associated with different financial instruments. Security selection involves evaluating potential investments based on expected return, risk characteristics, liquidity, and market conditions. Investors analyze financial statements, economic trends, interest rate expectations, and issuer creditworthiness to identify appropriate securities for their portfolios. The topic emphasizes that investment decisions should align with institutional objectives, regulatory requirements, and risk management frameworks. Different securities expose investors to varying forms of risk, including market risk, credit risk, liquidity risk, inflation risk, reinvestment risk, and operational risk. Effective security selection therefore requires comprehensive analysis rather than reliance on historical performance alone. A key aspect of investment selection is understanding the trade-off between risk and return. Higher-yielding securities often involve greater credit exposure, longer maturities, or reduced liquidity. Government securities typically provide lower returns but greater safety and liquidity, whereas corporate bonds and equities may offer higher returns with increased uncertainty. The topic explains that diversification is essential because concentrating investments in specific sectors, issuers, or asset classes can amplify losses during adverse conditions. Portfolio managers therefore balance asset allocation carefully to achieve desired performance while maintaining acceptable risk exposure. Stress testing and scenario analysis further help investors evaluate how securities may behave during changing economic or market environments. The topic also discusses credit analysis and market valuation techniques used in investment security selection. Credit analysis evaluates the financial strength and repayment capacity of issuers through measures such as leverage ratios, profitability, cash flow stability, and debt service coverage. Market valuation techniques examine whether securities are fairly priced relative to their expected cash flows and associated risks. Fixed income investors monitor yield curves, duration, and spread movements to assess bond attractiveness, while equity investors analyze earnings potential and growth prospects. The topic emphasizes that security valuation is highly sensitive to interest rate changes, economic conditions, and investor sentiment, requiring continuous monitoring and disciplined investment processes. Topic also examines investment maturity strategies and maturity management tools used to control interest rate risk and liquidity exposure. Maturity management involves structuring investment portfolios according to expected cash flow needs, market conditions, and risk tolerance. Short-term strategies emphasize liquidity preservation and lower volatility, while long-term strategies seek higher returns but expose investors to greater interest rate sensitivity. Common maturity strategies include laddering, barbells, and bullet portfolios. Laddering distributes investments across multiple maturities to reduce reinvestment risk, while barbell strategies combine short and long-term securities. Bullet strategies concentrate maturities around a specific target date to match anticipated funding requirements or liabilities. The topic concludes by emphasizing the importance of maturity management tools in balancing liquidity, profitability, and risk within investment portfolios. Duration analysis, gap analysis, yield curve analysis, and immunization strategies help institutions manage exposure to changing interest rates and funding conditions. Institutions must also consider liquidity needs because long-term investments may become difficult to liquidate during stressed market conditions. Effective maturity management supports financial stability by ensuring institutions can meet obligations while achieving investment objectives.